IS-8 accounting policies change in estimate and errors. Accounting policies are basically the basis rules, principles, conventions and rules, and to prepare financial statements. For example, depreciation method, for example, straight line versus reducing balance method, inventory valuation, for example, FIFO versus weighted FCO. So the question is that how to select an accounting policy. When there is an I when there is an IFRS, just apply that. But if there is no IFRS, then develop your judgment to develop your own policy. And no IFRS dealing with a similar transaction, use conceptual framework or other reporting rules. Another thing to mention is that apply policy consistently to all similar items of transactions. Change in accounting policy. Well, when to change accounting policy? When the IFRS requires it or new policy or change results in more reliable results. Reasons for the change in accounting policy. As discussed earlier, the change in accounting policy is permitted only if mandated by a new standard. For example, if IFRS issued a new standard requiring a change in inventory valuation method or to improve the information, providing more reliable or relevant financial information. For example, switching from cost model to revaluation model for property valuation. The change in accounting policy is a retrospective application, which means that it adjusts prior period financial statements as if the new policy had always been applied. Adjust opening balances of asset, liabilities, and equity for the earliest period presented. For example, if a company changes its depreciation method, the previous year's financial statements are adjusted to reflect the new method. But there is an exception to the retrospective application. If it's impracticable to determine the effects of the change, apply the new policy retrospectively. Like you will be applying it in the future. For example, if historical data is unavailable to recalculate the depreciation, then you will be adjusting the future financial statements. Disclosure requirements. Highlights the need for transparency, disclose the reasons for the change, the nature of the change, the financial impact on the current and prior period, and if the retrospective application isn't feasible, explain the reason why. Examples of policy changes. Change in inventory valuation from FIFO to weighted average, depreciation method from reducing balance to straight line method, and revenue recognition adopting IFRS 15 over an older method. Impact of policy change. Affects key financial metrics like profit, equity, and taxes. Ensure financial statements are consistent and comparable across a period. Key point to remember here is that only make policy changes if required by IFRS or to improve the reliability or relevance. Always disclose the change and its financial impact. Always remember that the retrospective implication unless it's impractical.